Hi everybody, Thomas here. As a value investor, it's interesting to see the different variations on value investing that people like to try to find. Dogs of the Dow is a strategy that recycles itself every single year. The idea is to take the last year's 10 worst performing stocks in the Dow Jones Industrial Average, buy them all, and hold them for the next year. And then at the end of the year, you sell all of those stocks and then you start over again with the 10 worst performing stocks of that year. And you recycle this process again and again and again. The idea is that since you're starting the year with the last year's 10 worst performing stocks, you're likely to be working with almost all of the stocks at relatively undervalued levels. And therefore, over the next year, if the market recognizes the value in these underperformers, then you're going to be able to outperform the Dow Jones Industrial Average. Although I'm not on board with blindly buying the 10 worst performers of the last year, it does appeal to my contrarian nature, which is to recognize stocks that have been underperforming relative to the rest of the market. One of the dogs of the Dow in 2023 was Verizon Wireless, which followed an extended downward trend throughout that year and bottomed in November of 2023 at a little bit below $31 per share. In 2024, it hasn't exactly outperformed the rest of the market, but it is up from a starting point at around $37 in January to its current price at around $41. So it's up a little over 10% to this point of the year. The real question for me at this point isn't necessarily whether or not I want to go buy all of the stocks that make up 2023's dogs of the Dow, or even the dogs of the Dow of the first half of 2024. But when I look at a stock like Verizon, which I've been following for a while anyway, I want to know, what does the business look like right now? Are the fundamentals solid enough to warrant thinking about using Verizon as a practical investing opportunity? Has the stock's increase since November of last year already run the stock past the point of useful value? Well, that's what we're going to dive into today. Verizon's free cash flow has been improving pretty impressively over the course of the last year. Starting in the middle of 2023 at about $14.8 billion, this number has increased as of the last quarter to a little over $19 billion. That's an increase of almost 29%, and that's the sign that the company is expanding its margins. Its overall profitability is improving. That strength has also followed in each quarter of the past year, as it's gone from 14.8 to 16.3, then 18.7, and then again a little over 19 billion in the last quarter. On the other hand, the company's cash over the last year has actually declined by a little over 50%, starting a year ago at about $4.8 billion, and then declining in the last quarter to just a little over $2.3 billion. Now that did mark an increase from the last quarter at just barely over $2 billion. Like a number of other companies like AT&T in the wireless space, Verizon carries a lot of long-term debt. As of the last quarter, this number was about $136 billion. That was a small decline of about 1.28% from a year ago when it was a little bit under $138 billion. Another really useful way for me to evaluate a company's overall profitability is to compare net income to revenues on both a quarterly and an annual basis. Now, over the last year, net income was about 8.44% of revenues for Verizon, which is generally pretty healthy, but this number also improved in the last quarter to just a little under 14%. Now, that improvement is a confirmation of the positive pattern that we see in free cash flow. And those two together are a strong indication that the company is on strong financial footing. And even though they do have a lot of long-term debt, debt service isn't going to be a problem. One of the really interesting things about telecommunication stocks like Verizon, AT&T, and some of the others in this industry is the passive income opportunity that they offer. Verizon pays an annual dividend of $2.66 per share, which at its current price translates to a very useful dividend yield of almost 6.5%. Now that's really interesting if you're looking for a way to generate passive income by holding stocks. That's well above what you're going to get in even very long-term treasury yields right now. And it's another reason that I've seen a lot of analysts who are fans of dividend investing pointing to telecommunication companies like Verizon as proxies for bond holdings. Along with the dividend yield, the company's downward trend from 2023, even though the stock has recovered quite a bit from that low point in November, is still very, very attractive. In fact, my overall valuation analysis puts Verizon's fair value target at just a little over $63 per share. That means that from its current price, a little bit above $41 right now, the stock has a little over 50% upside in the long term. That's really attractive, and when you tack on that 6.5% dividend yield on an annualized basis as well, you're looking at overall long-term upside in the neighborhood of 60%. As I mentioned, the stock is only up about 10% for the year in 2024, and for the past few months, the stock has been mostly moving sideways and hovering between current support right around $39 and resistance at about $41.50. That means the stock is just a little bit below resistance right now, but it has been rallying off of support in the last week or so to get to that point, and an increase in buying activity could push the stock above that. If it does push above 42, then it should have upside to about $44, which is a level that the stock has not seen since about August of last year. Now, if the stock reverses its current bullish momentum and drops back down below current support at about $39, it looks like it should find next support at right around $38. That's where the 200-day moving average is sitting, which is also angling up quite nicely and offering some strength to the overall upward trend that has been forming since November. That means that even if the stock does break below current support, there's probably pretty limited downside in Verizon right now. All told, when you consider the way that the stock's trend is starting to develop and extend itself, along with the company's really attractive value proposition and that above average dividend yield, I have a hard time calling Verizon a dog of the Dow. This actually looks like a pretty interesting buying opportunity if you're willing to be patient and take a long-term perspective. Thanks everybody. If you like this video, please go ahead and give me a like and go ahead and subscribe to my channel and help me grow. If you're interested in taking some of the principles that I've been talking about in this video and learning how to apply them to a conservative income generation system, check out my Patreon page. The link to that site is in the description area of this video. Thanks again for your time. I'm Thomas. Talk to you again soon.